The excitement around AI is facing a harsh reality check, and it's shaking up some of the biggest names in tech. But here's where it gets controversial. Are we witnessing the beginning of the end for the AI-driven stock surge, or just a natural market correction? Let's unpack what's really happening and why it matters to everyone, from casual investors to industry insiders. Recently, U.S. technology stocks saw a sharp decline after growing skepticism emerged about whether the current enthusiasm for artificial intelligence is justified. This sell-off hit some of the year's standout performers hard, sparking concerns that the AI boom may be overhyped. Take NVIDIA, for instance. The semiconductor giant famously propelled to a $4 trillion valuation largely on AI expectations. It dropped by 3.5% in one day. Similarly, Palantir, a major player in software analytics, plunged 9.4%, while ARM, a notable chip designer, saw its shares fall 5%. These numbers are significant because they highlight the sudden loss of investor confidence in what had seemed like unstoppable growth. The impact wasn't limited to individual stocks. The Nasdaq Composite, loaded with tech companies, closed down 1.4%, its steepest single-day drop since early August. Meanwhile, the broader S&P 500 also slipped by 0.7%, indicating a market-wide retreat from riskier tech investments. The ripple effect extended globally. Asian markets followed Wall Street's downward trend, with Japan's Nikkei 225 retreating 1.8%, South Korea's Kospi sliding 1.9%, and Hong Kong's Hang Seng easing by 0.6%. This highlights how intertwined global tech markets are, especially when it comes to AI-related sectors. One of the main triggers for this downturn was a stark report released by a team at the Massachusetts Institute of Technology, MIT. The researchers delivered a sobering message. About 95% of organizations aren't seeing any financial return from their investments in generative AI technologies, the same technologies that have powered recent stock rallies. Simply put, while AI pilots exist in many companies, only about 5% are generating millions in measurable value. The rest are struggling to turn their AI projects into real profit, leaving investors understandably nervous. The story is spooking people, commented a trader closely connected to a multi-billion-dollar U.S. tech fund. This unease resonates because it challenges the belief that AI is an instant goldmine for businesses. Adding fuel to the fire, OpenAI's CEO Sam Altman dropped a bombshell just days before the sell-off. He openly acknowledged the possibility of an AI bubble, suggesting that investors may be overly enthusiastic. Altman said, "I do think some investors are likely to lose a lot of money, and I don't want to minimize that. That sucks." Yet, he balanced this with optimism about long-term societal benefits, noting that while there will be periods of irrational exuberance, the overall value brought by AI will be enormous. This renewed skepticism comes roughly 7 months after Chinese AI company DeepSeek rattled markets by claiming breakthroughs achieved with considerably less computing power than their U.S. counterparts. Back then, concerns flared about whether American firms truly dominate AI innovation, and if global demand for their chips might wane. On Tuesday, declines focused on some of the year's biggest winners. Oracle and Advanced Micro Devices, AMD, two top large-cap stocks since May, dropped 5.9% and 5.4% respectively. AppLovin, an advertising platform within mobile apps, also lost 5.9%. Even cryptocurrency-related assets felt the pressure, with Bitcoin falling 2.7%, dragging down stocks like Strategy and Metaplanet that are late to the crypto market. Jacob Sonnenberg, a portfolio manager at Irving Investors who focuses on tech, summed up the mood. "The market has been on fire, and today you saw a rotation out of a lot of the very hot, high-momentum names. This suggests investors might be locking in gains or shifting to less volatile opportunities. Reflecting on DeepSeek's earlier announcement, it's clear how sensitive investors are to reports that challenge the status quo in AI technology. While markets eventually bounced back from that scare, it underscored the fragile confidence surrounding AI leadership and chip demand. Interestingly, as tech stocks faltered, more defensive sectors like consumer staples, utilities, and real estate gained ground. Around 70% of the S&P 500 stocks actually ended the day higher, indicating a broader market resilience despite tech stumble. It's important to remember that technology has been a key driver of the market's recent gains. For example, the S&P 500's information technology subindex surged 14% since mid-May alone, led by AI-connected companies such as Oracle and AMD. So here's the critical question. Is the recent tech sell-off a temporary reality check in an otherwise promising AI revolution? Or are we witnessing the early signs of a burst AI bubble that could reshape investment landscapes? How do you view the balance between AI's potential and the risks of overvaluation? Share your thoughts and join the debate. Are investors betting on a winner or caught up in a hype cycle poised to disappoint?